video will focus on this problem we've got here on Treasury stock. Now, one thing I want to mention quickly is I'm not going to answer the problem in the order that's listed here, A through D, just because I'm going to be talking about each of these elements as we go through the journal entries. So you'll have to kind of pick apart from the video as you're creating your homework to make sure that you've correctly answered A through D. So here's the problem, right? We've got all these Treasury transactions that happen throughout this year that we're given, and I've summarized everything here. I'm trying to visualize this for you, and up here you can see this picture I've created that shows us on one side of the. So remember that in accounting, our goal is to analyze, journalize, post the accounting transactions that have some sort of an effect on the financial statements, so we can get those financial statements out to the users that need to use them, like the creditors and the investors. So that being said, every transaction we look at, we look at from the perspective of the organization. In this example, it's Sweetwater Incorporated, and I'm trying to figure out, okay, we just had a transaction involving some of our shares, and so what's going to happen to our records, our financial records, in the way of stuff going out and stuff coming in, right? That's the hardest part of accounting, is trying to analyze the transaction to figure out what's really happening. So in this case, remember, we've learned now that treasury stock is when a company goes out and they reacquire their own shares from their shareholders. That's why I've got a picture of the shareholders over here and the company over here, because those are the two parties of this transaction. And when we go out and we purchase treasury stock and we're the organization, we have cash leaving the organization, and it's going out to some of the shareholders, and it goes to the shareholders that are willing to sell us their shares. In exchange, we get to take back the stock. The ownership interest that was previously held by these owners comes back to the organization. And so that's what happens on July 15th when we reacquire 24,000 shares, and the market price is $60 a share. Right? So that just represents what we have to pay to retrieve the stock. So, okay, so obviously our cash is leaving. So I have cash over here. My cash account will decrease, which is represented by a credit, and the cash is an asset. It's going to decrease by this 24,000 shares times the price I'm paying per share, $60. $1.44 million. So I can do this in T account form. I can do it formally on this journal sheet here, and I'll do it in both ways. So let me just let me give it the year here. That's fine. So, oh, hold on. Okay, that's fixed. So I've got the date, I've got the account. Now debits always come first. And remember, debits have to equal credits. So this $1.44 million, I'll just link to it here in Excel. I'm going to get rid of some of these zeros. The debits have to equal the credits. So our journal entry is going to, sorry for these formatting issues here. So debits have to equal credits of $1.44 million. So we know we're going to credit cash because the cash is leaving the organization. And most people think that, okay, we know the assets are going down. Cash is an asset. I've got my balance sheet here. Assets are going down. The accounting equation states that something else has to go up on the left side or something has to go down on the right side. And most people think of treasury stock being, well, this is an asset, right? We're reacquiring our shares. We get to hold them. We own them. And so the definition of an asset is something that value that will create future benefit to the organization. You can make a strong argument that treasury stock should be an asset, but it's kind of counterintuitive to think that ownership of it in ourselves is an asset. So for that reason, we take and we show the purchase or the reacquiring of treasury stock as a reduction in equity. And so that's a treasure. You can see that we have to debit something, and that debit is to the treasury stock, and this might be kind of confusing, but here, so we debit treasury stock for 1.44 million. Remember, this is what we call a contra equity account, meaning that the signs are contrary to what they usually would be for an equity account. Remember, an equity account usually has a plus on the right side and a minus on the left side. Well, this one doesn't, because it's a contra account. It contradicts the normal rules of the account. So what happens then is, by debiting treasury stock, we're really decreasing equity, okay, because this is a form of an equity account. So equity does go down, and the assets go down, so the accounting equation does hold true. And so I could debit right here treasury stock. And that would be the only entry that's needed. We're using the cost method to reacquire the shares on July 15th. Okay, so we know the effect on the balance sheet. Assets go down, equity goes down as a result. The balance sheet is smaller. Cash left, ownership left, and it's journalized appropriately. Now remember, a company buys back its shares for several reasons. One of them could be because they think that the price is undervalued, so they're trying to create some impression in the marketplace that if they're going to move and buy back some of their shares, they think it's undervalued, and maybe they're the ones that know they've got a new product coming out in the future and they want to bolster the value of their shares because the CEO and the board of directors, they might have an interest in the organization, and so their goal is to try to always increase the value for the shareholders. So by buying back shares, it's boosting the share price, market value, which helps the shareholder. That's one reason. Another reason could be simply to acquire those shares so that they can distribute them to their executives in the form of compensation. Right? That's another reason. They could be reacquiring them to get their balance sheet back in order by reducing the amount of equity. We're actually reducing the dilution of the shares, so there are less hands in the pot. So those are some reasons why we would buy it back. But when we buy it back, we hold on to it, and then at some point we need to do something with it. We either give it to those executives, we could retire it, or we could resell it at a later date. Now, it's counterintuitive to think that a company would resell its shares to earn a profit, and that could be a way you could think, well, why wouldn't they always do that? Because they're the ones that know what's happening within the organization. They could always buy low, sell high, and make extra money for the shareholders. That's true, but that's insider trading, and that's illegal. So what we tend to think is we don't buy treasury stock to resell it to earn a profit. That could happen, which is what happened on August 10th, and this isn't even listed in your book on how to account for this when the shares are sold at a higher price than what we originally acquired them for. But I wanted to take the time to explain it to you because anyone can do this entry, right? We know what happens when we acquire the treasury stock. Treasury stock increases, cash decreases. So the assets decrease, equity decreases. But I wanted to show you, well, then what happens in a subsequent period when we go and we sell the shares? Some of the shares, we even sell all of them, right? And let me just put some dates next to these T accounts so we can keep these straight as the numbers start to populate the accounts here. I know that's kind of off the screen, but so we're going to go ahead and sell now. Now what would happen then if you're looking at the account and trying to visualize, really what we're doing is just swapping this, right? We're going to say, okay, we had these shares and we held them in our treasure chest, and now we're going to go back out and sell them. So we're going to issue more shares, the ones we held, and in exchange we're going to get cash. And this time we're getting $63, which is $3 more than we purchased them for. So cash is always the easiest account to journalize when you have that as part of your transaction. Very simply, we're going to take the 19,000 shares times the $63 per share. Our cash increases by $1.197 million, and so I could put somewhere over here that this is the August 10th transaction. I know it doesn't show up because I'm going to leave it, but the date would be there. Now, here's the tricky part, and this isn't in your book, so you need to pay attention. Since we're using the cost method to account for the treasury stock, what happens is this is valued at the cost of $60. So when we pull the value out of here, we're getting rid of some of these treasury shares. We can only account for the shares to the extent that there's a cost sitting here, and that's at $60 a share. So when we pull, what I mean by that is when we pull out 19,000, you can only pull it out at $60, not $63, which is what I just did, right? Yep. So August 10th, we pull out $1.14 million, which now causes a problem for us because debits, assets went up, cash went up, we got cash, don't equal credits. Equity went up, we sold some of the stock back. And so at this point in time, we're not issuing new stock, which is, there's no common stock account that's chest and now are issuing. So we don't deal with common stock or paid in capital in addition in excess of par for common stock. What we do is we take the difference. We don't really, what's happened here is we've gained $3 a share times $57,000 we just made on buying and selling our own shares. So you could make an argument that net income should increase. But remember, we can't make money off of buying and selling our own shares. It's counterintuitive, it's illegal, and so we can't push this to an income account, which then flows its way through an income statement down to the equity account through retained earnings. We can't do that to retained earnings. So we create a separate account called paid in capital from treasury stock, and we push the difference from the 1.19, the proceeds of the sale, minus the 1.140, which is also $3, the difference between the selling price and the acquired price, times the 19,000 shares. So this happens on 8/10. Oops, it's not formatted right. But that's what happens on 8/10. Okay, so that entry, if I were to put it in journal form on 8/10, I get cash. I'm selling my stock, right? We've already done this. I'm just moving it from T account form. Again, I'm sorry about the formatting here. So cash goes up, treasury stock goes down, crediting treasury stock, and by crediting that account, it's a contra equity account. We're actually increasing our equity. I know that's hard to wrap your brain around. And then the difference goes to this paid in capital treasury stock. So the shareholders are the winners here, really, because we're saying that that value has increased, and they're the beneficiaries. So what happened in this transaction is assets went up by $1.197 million, and these are both equity accounts. Remember, there's a contra equity account, but so by saying it goes down, we're actually increasing equity, and a paid in capital is an equity account. So the ownership interest, the value of the ownership share goes up by the same amount. Okay, so that's the effect on the balance sheet. And there's no effect on the income statement, which is important. No effect on the income statement. These are all balance sheet accounts. Okay, the last entry here is on 12/28. And on 12/28, we sell the remaining shares. See how we still have 5,000 sitting in the treasure chest. We sell those 5,000 shares, but the price went down for whatever reason, and it went down below our cost. Oh gosh, okay, so it went down below our cost. All right, so again, what's happening here is we're the organization. We're issuing back the 5,000 shares. We're going to receive some funds in exchange, and we're going to receive 5,000 times $56. 5,000 times $56. We're going to get $280,000 in cash. Remember, now we don't dip below the cost. This is always going to be accounted for at the cost. And what I mean by that is the 5,000 shares times the cost we put those shares into the treasury stock account for, which was $60. So $300,000 comes out of this account, and the price subsequently drops. Our debits don't equal our credits by $20,000. What do you do with that difference? That $20,000, you can't just say debits just don't equal credits and move on. You could say, well, we lost money on that, right? So we lost money, so there should be logically a loss that comes through on the income statement, and the loss on the income statement flows through and reduces equity. Again, we don't want to show a gain or loss on an income statement from buying and selling treasury stock. It confuses investors. So we take that $20,000 difference, and we pull it from this paid in capital and exit, or paid in capital from treasury stock, if there is any, and there's this $57,000 balance. We can pull $20,000 out. We do that on 12/18. I know you can't see it. Move it over here. On 12/18. And so debits, well, let me build the account here. 12/18. We get cash, 280. And I'm sorry for the zeros again. Just bear with me here a second. Okay, so we debit cash for 280, but we pulled out of an equity went down, and then it's logical because we lost money. Equity went down. The value of the organization decreased by $20,000. I don't know why that's doing that, but so then that's going to reduce the paid in capital from treasury stock. Okay, and then the last thing is to credit this account, the treasury stock value for the $300,000, which completes our account. So what you'll notice then for this account, if we just look again, I kind of discussed what happens on the balance sheet. Assets go up by 280, and therefore assets either have to go down by 280 or something over here has to go up by 280. Okay, well, treasury stock went down, but remember that's a contra equity account, so it went up by 300 but pulled 20,000 back down because of the paid in capital account. So the balance sheet does balance. There's no income statement account affected here. And the last thing I'll mention is that, look, we bought 24,000 shares right here, sold back 19, sold back 5, and so there are no more shares in treasury stock. We can just verify that the accounting is accurate because we put in 1.44 million, we pulled out 1.44, so the value is 0, and that's logical. There are no treasury shares left. Okay, so that should bring us to the end of the problem. Let me just peek back here to make sure I've answered all the requirements. We journalized the entries. We talked about the balance in paid in capital from sales. Yep, we did talk about that. Where will the balance be? We talked about the balance sheet, and we talked about some reasons for why we would buy the treasury stock. So sorry for such a long video, but I wanted to give you a harder problem that the book doesn't even talk about some of that. So hopefully that makes sense. If you have any questions, stop by and see me.